Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast. With me, I got Nick Fusco, CEO of PM Insights, a pre-IPO secondary market pricing company, and Evan Cohen, founder and chief operating officer of WithVincent.com, a media company focusing on alternative investments. All right, fellas, we're going to hit some metrics today. It's a heavy numbers day today on the pod. So the first thing is that the one thing I talk a lot about with my investors is, can you have a proper U.S. equity allocation, right? Or stock allocation, maybe global allocation, if you just have public stocks. And it's starting to resonate with people, right? That's kind of what's happening, right? So just some quick numbers. Like, I got the S&P up 36% over the last year. This index that I run, this top 10 stocks equally weighted, that's the top 10 by valuation, is up 67%. Ish. I'm sorry, that's a year-to-date number, so maybe I'll come back to that. But Nick, you have the PM50 at growth at up 25% too. But maybe I'll pose that question, right? And we can dive into some of the numbers here too. But just to pose that question, like, how do you guys think when you're thinking about asset allocation? Is it a fair statement to say you have to have exposure to pre-IPO stocks to have like a proper equity allocation now, because some of these companies are staying still private for longer? Like, Evan, what do you think?
Well, let's to be very specific though, not just U.S. equities, but U.S. technology sector specifically. I think it's challenging, but I do think it's possible.
Okay.
Of course, you're not gonna have the very big outliers like a SpaceX, but that's like OpenAI, for example. There are certainly NVIDIA's an investor, Microsoft's an investor, so you sort of can get like congruent exposure to it through just like one of these other big names.
Sure.
I think at the end of the day, if you're an investor and you want to get exposure to the upside and the next movement, I think it's very challenging to just hold public names. I think you're going to want it if you want to invest in the future, which the stock market is supposed to be a future,
right.
But you're investing in things in the future. I think it's somewhat challenging now with all of these companies staying private very long to really have a nice bet on the future. I'm not saying it's impossible, but I do think it's much more challenging.
Right. Nick, what are your thoughts, man, about this asset allocation question?
Same boat. I think Evan hit it right, that you can get allocation to a certain extent by investing into NVIDIA, investing into Microsoft, investing into these massive companies. But you're really a far cry away from any sort of pure play exposure to the companies you might want. It's kind of like saying, oh, I'm going to buy Berkshire Hathaway so I can get access to Apple. Right. You're getting a lot of Apple, but that's actually really outsized relative to the action you're going to get on OpenAI by investing in Microsoft. So I think you have to take on different strategies, like finding alternate means to invest in these stocks directly. I think that's super, super important. And it's getting easier, so that's really, really beneficial to that end.
Just to double click on what Nick said, I do think that, like, if you're trying to invest in a thesis sector, say like defense, you could today in the public markets, you can buy the historical big names, but you're not going to be able to invest in the Andurils, which are somewhat innovative on the future side. I remember back in like 2017, 2018, I really wanted to invest in the car sharing market or the ride hailing market. I remember Uber, Lyft were both, private, couldn't get exposure to it. I looked at the public markets. I'm like, well, I could buy GM, I could buy Ford, but I don't think these are like really going to give me that exposure that I want. And I remember feeling very oh, it's like, I know this is the future. Like, I can tell that this is the way things are going. Ride sharing is going to be a big deal. And I felt like, other than SoftBank, there was not really a way to get exposure to it. And I wouldn't say that was the best way to get exposure to it for what it's worth. And so that was like an example of a trend that, just because you invest, if you have a thesis and the trend that you want to bet on, that's nuanced, like I would say space technology, I would say like ride hailing, like it's going to be much more challenging without exposure to the private markets to that.
Yeah, it's interesting though. Like what I'm seeing to that point around access, right? It is harder to buy pre-IPO stocks than public stocks, for sure, right? That said, I found that access is less of a challenge. Actually, and I've been at this for about 3 years now. So I actually think it's less than a challenge now than it was 3 years ago. I can't even imagine what it was like in 2015. Like, it's easier. It's easier now. right? So Nick, I mean, you see liquidity all the time. Is there more liquidity now in the secondary market with these names than there was
Massive,
maybe a couple years ago? What do you talk to us about that?
massive amounts of liquidity in comparison to 1 year, 2 year, and 3 year years ago when you entered the space. And we have some data going back to kind of like 2016, 2017, 2018 time period. And that's really interesting to look at because there really weren't that many brokers. Now you're having this glut of new brokers entering the space, a number of people getting into offering up more tenders, a lot more companies willing to do tenders, willing to allow for lighter ROFR restrictions or
Right.
really allowing for better secondaries. SPVs are pervasive now. So even just if I'm going to look out 3 years, it's going to get a hell of a lot easier to access these names. And the three of us were discussing kind of our interests in 2020, 2021 prior to this. We're saying,
Right.
oh yeah, we paid through the nose on fees, and fees are coming down too. So your level of
Right.
access is increasing and your fees are
Right.
coming down. It's real, everything's really moving in that right direction so that if an investor does want to have what we would deem a proper asset allocation to go mixing public and private stocks and bonds and really looking at the whole spectrum, yeah, it's only getting easier from here, I think.
Yeah. So maybe just to put a point on that, and then I got a question for you, Evan. So I think the message to folks listening to this is you can buy these stocks. I think you need to have a partner to do it. And this is like so self-serving, so I apologize in advance. But it's like trading bonds. I find that trading pre-IPO stocks is like trading bonds. Like you got to know and have relationships with fixed income desks. So you could call Schwab up and say, "Hey, I want to buy a New York State, New York City muni bond," and you're like, "Oh, they'll get it for me." But like, what's the Schwab fixed income trader doing? They're calling Goldman and J.P. Morgan and Morgan Stanley and everybody else, and they're like, "Hey, this guy wants New York City muni bonds. Do you got any?" And they're like, "Yeah." There's no nothing on screen where you can just take down a bond, right? They work the order for you with the relationships. And that's how I find pre-IPO stocks trade. So if you have those relationships, there's plenty of access, right? If you don't have them, there's no access, right? So it takes time and effort and it's reputation. It's like a little old school Wall Street, right? But Evan, go ahead, Nick.
And the fee, yeah, and just to make that abundantly clear, you will pay through the nose on fees, or you will not get the best price if you don't have someone advocating for you, and just make sure that it's their fiduciary responsibility to do right by you as an investor, right? So,
Right.
So I would say, oftentimes it's better to pay the mechanic to fix your car than buy the book and do it yourself. And this is a great case of that.
Yeah, you step in the arena, you got to know what you're doing. That's for sure.
Yeah, and there are more players every single month here. And to your point on the other OTC markets, not to elongate the commentary here, but that idea of comparing it to other fixed income asset classes and the bond market is very real because of the way the broker-dealer network is set up. And that's a lot of the reason why we set this, our company PM Insights up at the time, was because we saw this market look very similar to the other over-the-counter traded markets, whether it's municipal bonds, loans, credit default swaps, any of those. A lot of what is occurring in this market to have a proper infrastructure, the right amount of transparency, a good balance, is really trending in the same way those did 10 years ago, 20 years ago. So
right.
Just, yeah, I know you always caution giving yourself a plug, but I think you do a great job of that navigation because of your time in market and understanding how to do it, right?
That's very kind of you to say that. All right, so Evan, this kind of begs the question though. So if you can get access, so now we've had that conversation. Let's just say people believe us and you can get access, right, to these stocks. Should you do it? Right. So we were talking about some numbers also. I just confirmed these numbers too, guys. Right. So the S&P 500 has done 36% over the last year. Right. So 12-month performance. I have 30 pre-IPO stocks under research coverage. So the simple average performance, and this is maybe getting a little cheeky, but whatever, it's index. It's indexing, right? So that's up 67%. And then Nick's got the PM50 growth index, which I'm not sure about that index methodology, Nick. So maybe you can tell us about that. But that's up 25%. So So it sounds like it depends on which stocks you buy. It's either better or worse than the S&P, right, Evan? Like, what do you think about some of those numbers, right? 36% for the S&P, 67 for this top 30 pre-IPO stocks, and then 25 for the PM 50.
Look, I think in a vacuum, the returns look very appealing, and they are. At the end of the day, if you have unlimited cash and you put the allocations and spread across the index, it should perform as we sort of just assessed, and it'll probably perform better than just buying the S&P or QQQ or something like that. Just at least in this scenario. Remember, we're sort of in a bull market. We have a lot of tailwinds coming off of a really rough last 2 years. Interest rates are projected to come down. Like, there's a lot of benefit, and we're entering a new paradigm shift of technology. When you ask like whether or not you should invest in it, there becomes a broader question, which I imagine, as an investment advisor, you're familiar with. It's like, well, what's your overall portfolio look like? Because remember, generally buying one of these names in the private markets requires a relatively large check compared to just buying the S&P, right? If you're trying to buy 50 pre-IPO names and the typical check, I'm probably even lowballing it here, but let's say it's 20K. You have to have a massive amount of cash to buy 50 names. And then that number, the question is like, okay, so what percentage of your entire net worth or investment portfolio should be in illiquid private securities? Which, I would say even probably like the more risk tolerant investment advisors say somewhere between 5 and 15%, maybe 20%. So then look, should you do it? Well, it depends on, what's your risk tolerance? What's your overall net worth? Can you afford to get the broad exposure, which gives you the diversification and the downside protection? And I would say most investors probably can't do that, which means that you're going to get more concentrated positions, and you're probably going to skew toward the top bigger names, which have less risk, the SpaceXs, the Stripes, the OpenAIs, which, certainly can perform very well, but it's just different because the S&P, you can buy $100 worth and get exposure to 500 names. It's just the diversification and risk profiles are very different. So, but I guess just to look at the whole holistic question though, look, 35% returns in the QQQ versus, let's say, 40-something% or 45% in the private markets, but with the liquidity, the available liquidity, the low check exposure. There's probably a lot of benefits of just buying the public markets at this stage.
It's a fair point. It's a fair point, right? So like Nick, I talk to guys at financial advisors, and we call this venture capital, but these late stage companies, can you almost even call it? I guess you could still call it venture capital, but the risk adjusted return profile is like very different for those companies Evan mentioned, the SpaceXs, the OpenAIs, the Stripes. Those are huge companies with huge customer base, huge revenue base, right? Nick, like, do you think that that's different than two kids in a garage, right? Like startup company.
Yeah, it's a lot different.
It's private equity. That's, I would say that the regulators have even assessed it as private equity. It's not venture capital.
Fair. What do you think, Nick?
I'll throw it out there and mix it up and say growth, but it's all the same.
Fair.
These are very well-run companies. They happen to be, if you're looking at some of the biggest, I've done a cross-section. They're on average about 13 years old or so. So they've had a little bit of maturity, but they're not the average age of the top 50 names in the S&P 500, that could be on average sometimes like 100 years old, And I think it's all about the liquidity profile that you're willing to tolerate. So if you're having trouble stumping up 20 grand or 50 grand to invest, you know what? I'm going to agree with Evan. This is probably not for you. But if you're willing to take a certain proportion of your portfolio and allocate it to, a 10-year clock, I think it's great. How many stocks have you sold prematurely and you just kick yourself? You're like, what? Why did I do that? If you can really set the patience factor in here and you're willing to put a slightly higher allocation, I think this is a brilliant way to invest here. But a certain proportion of your money, you should be investing in highly liquid assets like, pick Ford or any other public company you want where you could trade in and out of it 100 times a day. That's great. Or the ETFs, but I think you are missing a trick if you're trying to get broad diversification without touching any private names and you're thinking about a 10, 20, 30, 40-year time horizon or just accumulating generational wealth, right? That's where you start to really factor this stuff in.
And you get very low exposure to disruptors in the S&P.
Totally.
Yeah. Well, okay. So that point, right, Evan, that's kind of the thing I talk about with my investors all the time, right? Is if you could think about going back. So you have the Mag 7 now, right? A lot of those Mag 7 names aren't that much older than 13 years old, right, Nick? I mean, Meta, some Google, right? I mean, they were around like 2000. They kind of hit the scene. That's like 24 years. That's not that much longer, right? When you talk about long-term investing, it's just this tranche of companies now is so okay. Let's try this on. Meta, Amazon, right? All these Netflix, all these companies, they went public when they were small cap companies. They had less than, what's now a $4 billion valuation. Back then it was even lower, right? So these companies hit like $1 billion valuation ish. Meta was much higher than that, but and they would go public soon after, right? And then they were in the Russell 2000 and they kind of went through the Russell 2000 into the Russell 1000, the S&P 500. And then now they're, the Max 7, right? So that's not happening now. Like if you're not in the pre-IPO stock market, you're not getting that exposure at all. So like, I'm dying to see how this plays out. Like fast forward 10 years and these companies start going public. Is there going to be like a massive differentiation between kind of index returns? Because you've missed out on all of this. And I think the funny part is too, guys, is no one will ever talk about it. Like, no, because it's, you know what I mean? It's like out of sight, out of mind. Like no one's thinking about the US stock market or the US growth equity market, you know what I mean? With these names included, they're just saying like, oh, it's public stocks and this is how it's returned. So it's like, we can't buy them, so we won't even consider it. But I don't think that's right. I don't think you can do that anymore. Now that it's so, I think because the liquidity's there in the secondary market, you can access it. I think you have to start to consider it. So, okay, Nick, you put together some charts real quick. Let me throw these up. I think we might have hit on all of them, but maybe there's one or two nuggets you can pull out for us here, right?
Oh, that's great. Yeah. So the charts that are on screen are effectively reciting the numbers that Aaron shared earlier. And I think the key thing to compare on these is Aaron's got 10 names he's tracking, 30 names he's tracking, and typically within PM Insights we're tracking a 50 name basket, which has a gradual rotation. So it rolls monthly, but the bottom quartile could be swapped in and out. So you're always getting the most liquid names. Whereas I think Aaron's basket, correct me if I'm wrong, it would be a static play based on the actual vintage.
Yeah, it's like buy and hold. That's right.
Is that right? Okay, perfect.
Yeah.
And then within the PM50, we would also break out different subsectors. So we have entertainment, financial, AI, etc. So on screen, if you're watching, you are seeing a lot of those breakout names would encompass the AI sector. So that's up 55% versus the PM50 itself, which is up 25%. So really a profound difference, and that hits on that idea of the Mag 7 in the private world. And I think that's where you're seeing the big differential between your Metas, your Nvidias, et cetera, versus the broader index. But you are seeing the S&P 500 and the QQQ performing actually pretty similar for the last rolling 12.
So what's interesting though, right, Nick, is that that's not to say that like my stock research is any better than anybody else, because that's literally just the top 10 stocks by valuation, right? So this is more of like the largest companies, to your point around the Max 7, are outperforming. So it's not really a stock picker thing. It's just a simple, like the largest companies are driving better returns over the last 1 year.
Yeah,
year to
or
date,
it's just
right?
like the easiest ones to grab. So I know when I looked at this, it had to be 4, 5, 6 months ago. If you looked at those companies, so ByteDance was the same valuation as Coca-Cola, and now it's probably dwarfed it a little bit. SpaceX was the same size as Caterpillar for valuation, and now it's rocketed way ahead. OpenAI, same as Gilead. Yeah, no pun intended. Stripe was the same as Altria, and you're just doing more with less because the employee headcounts were way lower as well, and they were making much more. They were worth way more on a per employee basis too. So that's so interesting when you actually want to drop it in the S&P 500 and say, oh, where does it stack up? Because it holds its own for sure. A lot of these names.
Yeah. So Evan, I mean, you were talking earlier before we started about fees, right? As it relates to this stuff. Like, so you can buy the S&P 500 for a handful of basis points, right? Through an ETF. And, the funds, these private funds have fees on them. Like, just talk about that, your thoughts on that for a second.
Yeah, I mean, and so we were just talking about trying to do an apples to apples comparison. And at the end of the day, if you're looking at this chart and you're saying, okay, the return profile or the return projections of the private stock market are just based purely on the purchase price, the entry price of share price that you purchased, and then today's estimated value of the share price. It doesn't necessarily include the carry, because a lot of these pre-IPO investments, you buy them in an SPV and they have some sort of carried interest, which, for those who don't know, obviously is a percentage of the profits. So,
Right.
some of the, back in the early days, as we were saying earlier, those carry fees can be pretty expensive, somewhere in the between 20 and 30%. That's now, as the market has matured and there's substantially more players, more brokers, more liquidity, and more options to purchase, that competition has sort of whittled those fees away a little bit, and it's made it much more competitive. But, as I was just looking at this chart here, if the pre-IPO market is up 45% and the S&P or the QQQ is up 35%, and you assume there's a 10% carry and maybe a 75 basis point or 1% management fee, the fee profile, the return profile could be relatively similar. So it's not like you're going to you're not vastly outperforming here. That's, I guess, the point I was sort of looking at. You are outperforming, definitely on gross, potentially on net, but when you buy the S&P or the QQQ, you also get liquidity, you get dividends. There's a lot of opportunity to generate other things there that you might not get from the private markets. Not to mention, there's still a lot of headline risk.
Yeah. So I think the message I have is that I do think it makes sense to have an allocation to pre-IPO stocks, because I think in the long run they will outperform. Right. What I found in like the data that I look at, and I can show this to you guys like next week if you want to see it. But that even though it's a later stage and there's a different risk adjusted return profile, that you still get access to the power law, right? Which is this concept that you like one or two companies in the portfolio will really take off, and that's important because I think you still want to kind of catch lightning in a bottle, and you can still get that even in these like kind of later stage businesses. They'll have these opportunities to have dramatic gains in kind of short periods of time. Now, but also too, I think what's important is usually with earlier stage venture funds, like half the portfolio will end up being a zero. Companies will not work out, right? Where in these pre-IPO stocks, you don't really see that. So you get this interesting, like maybe they'll negative, but they won't be zeros, right? So you'll get something back on those investments, albeit it may not be an attractive return, but you'll get maybe something back, or if you do lose money, you'll lose relatively less than you would on an earlier stage fund. So your power law winners don't have to be as big, right, if you will, because there's less to offset on the downside.
Aaron, that's why I always ask you when we talk about this on episodes, it's like, so what is your estimated hold period and what is your return multiple? Because I look at a company like OpenAI who's raising at 157 billion, and I sit there like that, like yes, their potential is power law if it's $1 trillion business. I'll leave it at that. But when you were talking before about Meta and Google, Amazon, Netflix, like it's well known that the returns even in the public markets have been double digit multiples. So 5-10x.
Point.
The question is like, okay, so if you're going to hold SpaceX for sure, or OpenAI at over 100 billion or over 200 billion, how long do you plan to hold that asset, and at what valuation do you think it will be liquid at? And then you can determine your IRR, which historically venture capitalists are not good at. They don't really think about IRR as much as they think of return multiple and ROI. That's like the sort of benchmark that I like to compare when I'm like, okay, well, if SpaceX is going to 3x over the next 6 years, it's a power law, but it's a small power law. It's not like betting on Facebook when it was 100 billion and it's worth 1.6 trillion today. That's 16x.
No, it's fair point. It's fair point. So like the numbers that I have for this index, that it's the top 10 stocks by valuation, and there's vintages. So every January 1st, you strike a new vintage with the top 10 stocks. And I did that back to 2005. So it's 20 years. So to answer your question about return or how kind of when distributions happen. So the average years to return the fund. So if you put like 100 grand in, when do you get the 100 grand back? Is 4.1 years. right? So that means in some years you could be getting money back earlier, and other years you're getting money back later, right? But on average, you're getting that initial investment back in 4.1 years. And then the TVPI, it's a total value of paid in capital. I don't have the IRR numbers here, Evan, right? But that's 5.7.
Okay.
Right.
It's pretty good.
Yeah. So I think what's interesting about, and that's, but look, there's years that are really good and there's years that are okay, but there's only 1 year where you lost money. Right. And this is, of course, an index. Okay. So like to your point, there's, carry that would be layered in on top of this if you're going through a manager. Right. But, it's a different risk profile. It's really interesting, right? I mean, I know people kind of talk about venture. It's like, well, you got to be with those top quartile managers, or you're not going to be able to have really great like venture returns. I think in this later stage pre-IPO stock space, some of that is different. I think it's about getting the access, right? But I got to tell you one thing, Evan, you said. So maybe Nick, you guys could both comment on this. Like, how much money do you actually need to be able to allocate to this space, right? Let me stop the screen here, right? How much money do you actually need to allocate to get like diversified exposure? You know what I mean? Like, what are your thoughts? Like, maybe Nick, what are your thoughts on that? Just maybe minimum position sizes, things like that when you're kind of stepping into the pre-IPO stock space.
We brought up the word carry quite a few times. If you are happy to pay carry, you could do, reasonably a $10,000 position. Go for it. But you might pay a 20% carry. You might do a 2 and 20, right? If you could inch that up, once you start abutting where, I hate to say where we start to use the data, but really where it actually matters is you see a lot more direct activity and a lot of 0.0 SPVs is right around the 500K or $1 million mark. That's when the fees are going out the window, and it's really just what you negotiate to get in and out of the trade. So naturally, there's a bid and offer differential there. Could be anywhere from probably 5 or 10%, usually at the top end of that, and then you can negotiate it down and figure out really where you need to be. Even that will take weeks to do, as I'm sure we can all attest in the negotiation. But I would say it's a bit of a sliding scale between that $10,000 you're getting your ass kicked, but you're really going to pick the name that you wanted to invest in and you're going to feel good about, all the way up to your $250,000, 500K, where you're like, oh, I'm not getting abused, but I have to take this big position size. And I think it's going to get really interesting when something like what you were discussing before of a 10 stock portfolio is accessible for $250,000. That becomes really, really cool on a low fee basis, getting broad exposure, because it is still dangerous to invest in the one company you think is really great when you could go for 5 or potentially go for 10. But those dollar amounts start really going up, and that's where it starts to make sense. The fact that everyone's asking for your investor accreditation and things of that nature. So I don't love the idea if you had $10,000 like going at it and thinking you're getting a great deal. You really got to do a lot of due diligence here, because anything happening at that 10,000 or even all the way up to 50K, I hate to say, you're often not getting any sort of a deal unless you're getting it from the person that's sitting at the company.
So you could, maybe to call out a few things you said. So you could build a diversified portfolio with $10,000 individual stock position allocations, but you're going to be paying a lot of fees, right? And then if you brought more money,
oh no,
then
for 10K,
ideally,
I was saying just go for one stock.
Yeah. So like if you did $10,000 into 10 stocks, that's $100,000, right? You could build like a diversified portfolio with $100,000 allocation to this asset class, but you'd be paying like full freight on fees.
You're paying full freight. You're not necessarily getting good execution either, because
fair point.
Yeah. So you're
fair point.
Paying
so
on both sides.
Expensive, right? Which, you get, maybe you make 1 or 2 good picks, maybe it's okay, right? But to your point, if you're bringing more money, if you're doing 500,000, for the 10 stocks, which would be a $5 million position, right? Then now you're getting more to like institutional levels and you're getting direct exposure, lower cost.
And I think here's your allusion back to the fixed income market. We would call it an odd lot versus a round lot. You know, sometimes there are odd lots that go for cheap, and maybe you do even better there. And I certainly think there is a sweet spot sometimes where you just see a random $50,000 trade go out there super cheap because maybe the seller doesn't really know what's going on, and you're just kind of getting lucky. But I think I'd love to comment on this with Clinton, hear what he says, but this is an inefficient market. I don't think all markets are efficient. I think there's a lot of inefficiencies at play here. So,
Fair.
if you're super patient and you just keep dipping your toes in, maybe you'll get a couple of those really easy trades, easy money, but you can get a lot better consistent execution at a higher dollar price. Yeah, it definitely makes it more difficult to navigate.
What do you think? So Evan, what do you think? Like, do you step in this market if you got $100,000, or do you say like, this is not something I can play in and I should probably just stick to the public markets? Or what are your thoughts there?
So I think you can certainly play with $100,000, but you really need to jump into a pooled vehicle. Like you need to get some leverage. You need to join a vehicle that's playing with a couple $1 million. You might have a small position of that fund, and that'll allow you to get into the big leagues. And I think,
Right.
Just to sort of what Nick said, you're not going to get great execution with a small, whatever slice, or you're not going to get great fees with a small slice. But in fact, it actually gets even more exacerbated when you're going for bigger ticket names, right?
Right.
Like you could probably get into one of the top 20 to 35 names with 10K and decent execution and probably high fees. But if you're trying to get into one of the top 5 names, like an OpenAI or a SpaceX, where, the risk is somewhat down, like the downside is lower, but the upside and the name and the recognition and the brand is higher, you're going to be paying a lot of fees. I mean, we talked about it before the show, like getting into SpaceX in 2021, obviously the market was less mature. 30% carry. That's a pretty expensive even compared to today's market. And so I think that if you're playing with $100,000 and you're trying to go direct, you're probably going to have a lot of trouble really getting into great names at great prices, and even getting into decent names at not even great prices. But you can join, if you joined like, some sort of pool vehicle that was playing with 10, 20, $30 million, and they were just, you were aggregating capital so that you could have leverage and you can negotiate better terms. You could really I think you can get into you could have pretty nice exposure with $100K. And I imagine there's certainly funded managers out there that are building pool vehicles, trying to hit that top 10 or 20 or even 5 name positions, and will happily take $100K with some decent fees on it.
See, but so I would offer, Evan, like, I don't see a lot. That what you just said to me is investment advisors, right? Because they would do things like you would just say, right? Where there's a lot of brokers in the space right now, which don't really do that. There's, but there's investment advisors in the space, but they're not really like building out what I would call like thoughtful portfolios for people to invest into. So there's not like a lot of funds doing what we're discussing here, providing diversified exposure. And I would say more often than not, those funds are active versus passive, right? Mm-hmm. And they're really playing off of the illusion of access. So they're like, well, I can't tell you what we're going to own because I got to like see what's out there. And then I'm going to like take the position. You know what I mean? It's like it's a different kind of model. So, and the active managers, like most of them don't have a track record. Right. So there's nothing to really fall back on and say. And also to this asset class, I would argue is a little bit new, right? It's like 10 years old, 15 years old, like from track record perspective, that's not much time, right? Especially when these companies haven't gone public and they have no liquidity. So you have no exits, right? So that's tough too. So it's like, it's interesting because I agree with you. Like this is, look, financial innovation for the last 150 years has been really simple. You just pool people's money together to help them get access to an asset class that they couldn't get access to before. That's how mutual funds, that's how money market funds started. That's how mutual funds started. That's how ETF started. It's all like that, right? It's just one simple thing that just keeps repeating over and over and over again, right? Whether it's stocks, it started with bonds, right? Whether it was bonds, then stocks, then gold, right? And then other commodities, and like it just keeps repeating. So now it's happening with pre-IPO stocks. So like I think this is the right way to do it. I think as we get more funds in, to your point, Evan, we'll get larger funds that then can get rid of their minimums. They'll take somebody with a $100,000 check and they'll have 25 names in it, right? Or a $50,000 check with because they'll have some gorillas coming in, with like a $10 million check. So there's like balance there, right?
Yeah. I mean, yeah, I think, look, there's some regulatory challenges. So like, closed-end funds, especially ones that are 40 Act funds, they have liquidity requirements, meaning they can't just have a full portfolio of private stocks with no liquidity. But if that somehow changes, or if someone wanted to create a like FANG plus 5, so like a FANG private, FANG plus like, or Mag 7 plus Mag 7 private, like a 14 holding portfolio, you probably have a lot of really interested investors in getting that. But it's challenging because these funds, they have to raise capital before they can deploy the capital. Right. And there's a lot of disadvantages to the asset manager trying to do that, because one, if you're an asset manager and you have to go buy SpaceX and there's a seller on the other side who knows you have to buy it, you have no leverage. You have to buy it. Yeah. You're a price taker, not a price maker. And so like, it's very challenging economics. And I think it will happen. And we do need more asset managers. I think we have a lot of investment advisors who are trying to gain portfolio exposure, SMA exposure, but would love to see more asset managers get into the space, building portfolios and funds and ins and outs that make it work. It will get there. I think it's just a matter of time.
Okay, let's talk about this one last topic, because we're running long. We ran long on that first one. So there's some surprise. This is year-to-date performance, right, for the top 10 stocks as of the beginning of the year. So on January 1st, if you said what were the top 10 stocks by valuation, pre-IPO stocks by valuation, these are the names that would have come out of that group of 10. And then I've sorted this by performance, year-to-date performance, right? And then here's their entry valuation, secondary market valuation, and their current valuation, right? So some of these names are surprising.
Is you've said, what would be amazing if we could create it? And then we all agreed it doesn't exist. And then you just put it on paper so people want it. Look at that.
Right.
Right?
Well, look, no, but I mean, like, this is, I find this so interesting, because as I look at this portfolio, if you're an active manager, I don't know if these would be the names that you would have picked, right? Like at the beginning of the year, fintech was getting crushed, and Revolut, I mean, it was down big. It was down like 50%, right?
Right.
Go ahead, Evan. You're dying to say something. Let her rip.
So there's definitely, I totally agree. There are definitely names on here that I still probably wouldn't even buy today. But
okay,
Evan, read them off just in case someone is listening on the phone.
Well, there's okay. So in order, and none of this is investment advice for the record, but so number 1 is Revolut, number 2 is Rippling, Anduril, OpenAI, and number 5 is Klarna, number 6 is Stripe, 7 is Anthropic, number 8 is SpaceX, number 9 is Databricks, number 10 is Epic Games. Now, the number 10 is the one that I have the most asterisk on as a shareholder in Epic Games, because while it is up 21% since the beginning of the year, it is down substantially from its $37 billion mark in 21.
Right.
So
it
all depends on when you bought in, not when you. So so there's just like some factors in that, and we talked about that on the show here, right? Like it was trading at 13.7, it raised at 21 with a round led by Disney and Lego.
Disney, yeah.
But now it's back at 16.6. So it just shows that like those funds probably
have a lot
overpaid.
of lawsuits. They have a lot of lawsuits. Epic Games. I wish they would. It'd be interesting to see what happens with those. But I mean, are you guys surprised by? I mean, I was surprised. I would have thought AI names would be at the top of this list, right? Not fintechs and HR management, right?
But if you're going by valuation, I know the way Evan read them was by return, but they're still the top 10 by valuation, right? In terms of what is VC backed. A lot of these names have had more time to run, because they weren't Epic Games I wouldn't classify as an AI stock, nor SpaceX, nor Klarna. Maybe we would Klarna a little bit now, but they're just employing the technology. They're a buy now, pay later.
Fair.
And that one, more than most, has been clobbered, and that's on the way back. And I think we all saw they took the bottom so hard on that, you almost couldn't bet they'd go down any further. So I'm really loving the performance on Klarna. That one is no surprise to me.
Yeah, I mean, there are some that are down. Like I think Rippling's still down from its prior high. Klarna definitely is. Like they were what, like 40 if
Stripe
I remember
is.
correctly.
Yeah,
Stripe was
I would
at
say
100 or 95, 100.
100,
I,
yeah.
Go ahead.
I would say 6 out of the 10.
Yeah.
Right?
Yeah. But this is what's interesting. And maybe this is why what this is coming as a surprise to me, right? Because, these were the 10 largest by valuation. It's not like there's any kind of like heavy active management stock picking here, right? This is just simple math, like the top 10 names, and this is how they perform. So, I couldn't believe Revolut was at 45 billion when I saw that, right? Because it was still,
I still
it was
don't believe
hovering,
it.
it was hovering around like 16, 17 billion. You know what I mean? At the beginning of even like before this announcement came out a couple months ago. And I was like very apprehensive to be like, this is what it is. As I was like talking with clients and advisors and everything, people who read my research, I'm like, I don't know, guys, like that seems like a huge jump, right? To go from like, I think it was 17 billion when I was talking with this fellow up to 45. And they kind of came out originally and said it was at 42. And I was like, I'll believe it when I see it. And then here we are. Like there's like multiple reports now that it's at 45. And they like closed rounds and closed investments from like sovereign wealth funds in the Middle East, right? So,
And they've got a great track record of investing.
Yeah, well, it'd be interesting. Revolut's going to be an interesting business. They have like some real value prop that they offer, I think, compared to other. Like we talked about this with Chime last week, right? How it's tough to run these interchange businesses, but they really have a subscription-based business. They have like these memberships, right, that people pay. That's a very different revenue model, I think. But any names jump off the list on this here as you guys are looking at it? Like, Nick, what do you think? Any like surprises or names that you think are interesting out of these 10?
We see them coming. We're a data company.
Yeah.
The one surprise I would put out there is if you look at names. So we have to do some sort of liquidity screening, or Aaron, I would imagine you did a liquidity screening before being able to put this name out there.
Yeah.
These names out there, but there are also the massive conglomerates, like Coke Industries, Cargill, or Mars Candy Company,
right.
Publix. There's so many massive private companies that would never even see any sort of liquidity.
Fair.
I just want to compare them in this mix. I think that would be really interesting one day.
Sure.
But it's almost impossible to get that level of detail. So
right.
I would say it's
trade,
very, very cool to see so much activity on these top 10 names, and actually activity that you could step into. Because if I wanted to invest in Mars, I can't. There's no way. Not that I
Mars,
do.
You're talking about the candy company, just
candy
to
company.
make sure everyone's clear on that. Yeah, right.
And then, if I wanted to invest in Mars by way of SpaceX, I actually can, right? Let's occupy Mars. But I think that's the big differentiator. Just to point out on these are names that are actually built and operated with that venture capital, with the aspiration that they will like keep growing and keep on pace to do something like an IPO.
Right.
But if there's so much liquidity, then you start to question that too. But these are the highly liquids when you compare them to the Cargills, the Cokes, and Marses of the world, which is unique.
What do you think? What do you think, Evan? What do you think of this?
I have a question for you, because I have my own thoughts, but I'm just curious. Okay, so all these names and all their current valuations,
right?
Which companies on this list do you think, if they went IPO tomorrow, would maintain or appreciate the current valuation you have in that current column after 90 days?
Oh, that's
with
interesting.
The disclaimer, not investment advice.
Not investment advice.
And this is crystal ball stuff, right? So I would say, I think Databricks would hold in there, right? Because they're doing like Snowflake's a good comp, and they look good next to Snowflake. So I think whatever they IPO at, I think they would hold in. I think any of the AI names would rip, an OpenAI and Anthropic, not because they deserve to, right? Just because there's a buzz around those names, right?
And they're underserved in the public market.
I think that's right. There's no way to really play like these pure play large language model type things.
Well, except for Microsoft and Nvidia for OpenAI.
Well, that's not pure play, right? Can we agree on that? Nvidia
it's not
is
pure
like
play,
pure
but
play.
it's kind of exposure.
Yeah, Nvidia is definitely
you're
pure
investing
play.
in teams and operating system. You're investing in a million and one things with a Microsoft, right?
Yeah, but
NVIDIA, you're
Microsoft
closer.
owns what percentage of OpenAI? They've got to open
It's a lot.
They have
It's
to own at
north
least
of
40 to
40.
25.
It's the other way
Oh,
around,
it's
though.
north
I
of
mean,
40.
of that X% ownership, how much does that account for the valuation built into Microsoft?
Yeah, that's got to be
a fair
small.
point.
Yeah, NVIDIA.
Well, yeah,
I think
definitely.
I think NVIDIA. That's 100%. That's all AI. So if you buy NVIDIA, you're basically right now. I think you're investing into AI infrastructure, right? Yeah, like what else? I think Andrew would be all right. To be honest, those guys are delivering. They win new mandates from the Army, the Navy, the Marines. They just did a deal with Australia's Navy. I mean, they are winning new mandates all the time. So I think Andrew would probably do okay. Revolut, I think I think Revolut might have a hard time. I'm not gonna. I think and then the SaaS companies, I would put like Rippling in that bucket. Yeah, Ramp's not on here, but Rippling I think would be tough. Klarna's an interesting one. Klarna's an interesting one. It's effectively a credit card company, right? They offer
Buy
consumer
now,
credit.
pay later credit.
Yeah.
There's public comps. You got obviously
Right.
Affirm.
They do a lot of payment stuff too, but I mean, what they're doing with AI, though, Nick alluded to that earlier, right? How they're implementing AI. I mean, they're really bought in, and I have to imagine that's going to drive incremental profit margin. When they get public, they're going to look like superstars because they're like massively embracing operational efficiency. So that I could actually see Klarna come out and maybe hang in there. I could see those guys acquiring once they get public because they'll just be running so much more efficiently. Like now that they got that public stock and they got that currency, they would just go out and use that to acquire. And I would think those guys would probably acquire enter new markets is my guess. But again, this is all crystal ball stuff, right? So
yeah, well, I guess what I'm pointing to is none of these assessments are really looking at the fundamentals effectively, with the exception of the comparables, right? Obviously, Klarna and looking at comps, or Revolut looking at comps, but you spoke Anduril, that's really long-term vision. Anthropic and the AI plays long-term opportunity. Databricks looking at the comparables, but also looking at the long-term opportunities. Okay. Stripe and Epic Games. And
SpaceX would definitely be a fundamentals, right?
For sure.
I think you mentioned Klarna, right? We agree on that. The Anduril, I think, would be on fundamentals. They turn a big profit margin over at Anduril, and they keep winning more mandates. They don't have a lot of customers. They don't have a lot of potential customers because basically it's governments, right? But I mean, Palantir made a business out of that, and I guess they started working with commercials. So it'd be interesting to see what they do. Databricks is a robust company. I think they got, but you're not wrong. I would say half of these, or maybe 6 of them, would trade on non-fundamental related stuff.
Yeah, that's what I sort of expected.
Yeah, it's going to be interesting to see.
Couldn't you say the same thing about Amazon 10, 15 years ago too?
For sure.
Right.
I mean, remember how
it was
Nick,
much
you're
smaller.
Right. No. Well, that's true. But also, Nick, remember how they were not profitable for the first 10 years?
They were never profitable. It took ages.
Right.
It took ages because
that's right.
But then by the time everybody realized the trick with AWS, it was like, oh my God, that reinvestment of capital was just outrageously brilliant.
It's exploded on the upside.
So I think you've got a lot of that here. Because if you want to compare Anduril to a Boeing or I don't know, pick a better comp actually, but the growth rate on that is just explosive. So you'll have a fundamental comp, but once you put the growth into comparison, it's not even going to make any sense, right? So I think that's how you want to look at these. Some of the darlings we had 10 and 20 years ago.
Okay, all right. Here, let me ask this last question for you guys. This is a question I get every phone call that I have, right? Which of these companies, which one of these companies are going to IPO first? No one knows. So we agree on that, right? But I get asked this question constantly, right? What's your guys' best guess on who would get an IPO?
Databricks.
I think that's a good. What do you think, Nick?
I'm going to say that Databricks is probably your safer answer. I think it would be appropriate for this company to IPO. So I'm just gonna put it out there, but I would like to see Epic Games go public.
Epic Games,
Yes.
even with the lawsuits and everything they have going on, you think that still be a
I
thing
I
that would
think
happen?
it will very much be to their benefit to
Yeah,
become a public company, take in that outside, like, last hurrah big outside capital, and
uh-huh.
start to set everything in a bit better motion. Um, I don't think the private market is actually treating Epic Games terribly well,
That I
despite the
agree with.
performance that you're showing here. So
That I agree with. Yeah,
that one, and they're one of the older companies in the list.
that is
So
They're the
true.
oldest
that
company in this list by a
Yeah,
lot, by like
okay.
probably 8 years.
yeah.
Yeah. So that
When
would
did
be
they
the most
start?
I think
appropriate.
93.
Oh yeah,
Oh,
that's
damn.
definitely because SpaceX was like closer to 2000, right? So
Yeah, I think they're
Yeah.
definitely the oldest company by
yeah, that's a little
92,
long in the
93.
tooth, man. I feel you on that. Yeah, I feel you on that.
What do
I
you
mean,
think, Aaron?
look,
If you can't pick Databricks and you can't pick Epic Games, what would you put in the
yeah,
mix?
like, I mean, lately I'm hearing a lot of buzz about OpenAI going public. I heard somebody say Microsoft was going to buy them, which, I mean, Lord knows they have the cash, and I guess they could also use their stock too. But that seems like an interesting one. Yeah, like I don't know if the AI companies will go because they need a lot of capital, and I think to your guys' point, the fundamentals aren't there. So like I don't know how the public markets would. It's too much of a gamble, right? On not knowing how the public markets would respond to that. If one of the AI companies go and it does okay, right? Then I could see others coming, behind it. But someone's got to take that first step, which is a doozy, you know. Stripe doesn't look, I'm not answering the question, but Stripe doesn't look like they're going to go, but like they're doing tenders every year, every 9 months. I don't think they're going to go anytime soon. Klarna's, there's a lot of discussion around Klarna, and those guys are going to starting to turn profit. Their CEO is sharp. Every time their CEO does an interview, he talks about going public. So I wouldn't be surprised if it's like Databricks or Klarna, you know, and then something starts to happen with the AI companies, right? But Revolut, I would just want to see like a snapshot of their financials, to have a good sense of whether they're going to go or not. And if they did go, I don't think they would go in the US. I think they would go in London. I think they'd probably go in London because that's where most of their customers are. So I think their stock would probably trade better over there.
Starlink? No one wants to talk about. No one wants to the spin out of Starlink.
Oh, that would be clever. Yeah.
Yeah, I mean, Starlink, it's interesting because there was a lot of discussion about that a couple of years ago, or maybe not that long ago, but like maybe a year ago. But now it's kind of not, there hasn't been a lot of discussion about it. But man, that's a monster business. It's
Totally.
huge. My numbers have them doing like 160,000, 170,000 new subscribers per month. Right?
Oh my God.
Per month.
Yeah.
And also too, I mean, not these poor people in Appalachia, right? North Carolina. It's horrible what's happening from the hurricane. But like Starlink is in there like saving the day. They're like connecting people to the internet when no one else can get to them. And it's like saving lives. So like it's like you can't almost get a better spotlight on what this technology and solution can do for people, right?
Yeah.
So yeah, it's like that could be that could be an interesting one, but I don't know, man. It's so SpaceX it seems like it's there's so many people that want to invest into SpaceX. Like I don't think those guys have to really do anything. They don't have to go public. They don't have to spin it out.
They're doing regular
right?
tenders, and if you look at who's at the helm, I don't know that Elon necessarily cares for that to be exposed to the public markets, right? So, yeah. There's an easy case to be made for all 10. They shouldn't go public.
Yeah.
Except for, I really want to see Epic go public because I think it'll actually do better.
Right.
But there's a case to be made on both sides, very, very succinctly. Yeah.
I will say this: the one company that would be interesting to have public that's obviously wasn't on that list is X, Twitter. Because that company is, I mean, naturally they lost a lot of revenue, but there's like people who like are passionately in love with that, like ride or die.
But it's such a those are those people. Do they have the capital to really carry weight.
Fair point. Fair point. Fair point. Fair point. That business though, that business, I have a feeling they're getting revenue. They're going to start getting revenue from XAI.
Yeah, but XAI is a separate company. I mean, Fidelity marked it down 73%, man. I don't know. I think that they're really struggling.
There was a business, and it was called Naspers in South Africa. Okay. They had bought a ton of Alibaba, right? The Chinese, like kind of Amazon, right? And Alibaba appreciated it so much that Naspers, it was like 90% of the value of the stock was Alibaba stock.
It's the MicroStrategy structure,
right? Yeah, exactly. This is exactly what it was. It's like I got to tell you, there's something about Twitter, like, with that stock that they own of XAI, because that was the rumor, right? That they own, that Elon Musk gave Twitter X stock in XAI. So as that thing XAI starts to appreciate, I could see that company being something that might go public, right? But yeah, I'm kind of dying for the IPO window to open back up. I think these companies have now, I think, like a Revolut now above its 2021 high. That's interesting. So even your investors that came in are now in the black, right? Some of these other companies are getting pretty like Anduril's like a big company now. OpenAI is huge, obviously. Klarna's might be tough. Like those guys might hang in there for another 2 years or something to try to get closer back up to where they were in their last round. You know what I'm saying? So
yeah, well, we'll have to wait and see.
Yeah. So okay, fellas, this is a good one. I appreciate a lot of numbers today.
Great.
This is not a normal pod that we have.
Thank you all.
We'll have to load up the comments in the posts just so you can see the and all that.
Yeah.
I think we should make some long-term bets. Let's do it.
Oh, you know what?
I'm gonna send an email thread out. I'm gonna send an email. You know what? You guys write your answers, and we'll come back in a year.
Yeah, you know what? We should do that. We should do that like in fourth quarter or something. You know what I mean? And then we can check it out. I like those. Those are fun. Get a few. Get
predictions.
But, okay, brother. I appreciate you guys.
Good hanging.
Thanks so much.
Thank
you.
Have
a good one. Okay. All right. Cheers.
Later.